Hi, this is Mike Larson from Money and Markets TV. By now, you should know that I'm no fan of quantitative easing, or in layman's terms, money printing by a country's central bank. QE typically affects the markets in several ways. It devalues the currency of the country that's doing the printing, it erodes the purchasing power of that country's citizens, it inflates the price of commodities, making every gallon of gas you buy, and many of the groceries you purchase, more expensive. It drives down the yield on virtually all of your savings vehicles, forcing you to take on huge risks to generate the same amount of income you made previously, and it artificially boosts the value of paper assets, including everything from junky bonds to stocks. But while QE juices the asset markets, it accomplishes almost nothing for the real economy. Or in other words, average folks on Main Street get screwed, but investment bankers on Wall Street hit pay dirt. They can peddle more stocks and bonds, make a ton of money, and maybe buy a new Ferrari or house in the Hamptons. The latest example of QE's ineffectiveness came from the United Kingdom just this week. The Bank of England has spent £275 billion on quantitative easing programs over the last couple of years, but they have less than nothing to show for it. The UK economy contracted more than expected in the fourth quarter of 2011, putting that country on the verge of a double-dip recession. Whoops. Meanwhile, the European Central Bank has instituted its own backdoor QE program by offering cheap loans to hundreds of Eurozone financial institutions. And now it seems to be the Federal Reserve's turn once again. This week, policymakers promised to keep short-term interest rates low through late 2014, longer than their previous pledge of 2013. Not only that, the Fed also said it was going to continue its Operation Twist policy of selling shorter-term treasuries and buying longer-term ones, with the overall goal of holding down long-term interest rates. Now technically that's not quantitative easing, but the renowned bond fund manager, Bill Gross of PIMCO, called it QE 2.5. Look, it's obvious by now that these policies are doing next to nothing to help the real economy. But Ben Bernanke and company aren't going to let the facts get in the way of a good story. They need to look like they're not just sitting on their hands. So they're going to keep doing the same wrong things and expect a different result. The best way to protect yourself from this folly is by using the strategy I've been recommending to my Safe Money subscribers. Owning gold, select fixed income investments that do not pose excessive risk, and select stocks with solid fundamentals. That will put you in a good position if the weak global economy persists, and you can get an extra boost from all the easy money flooding into the markets. Just please be sure to keep an eye on the exit doors, because somewhere down the road, all these harebrained money printing schemes will fail, just like they all have in the past. I'm Mike Larson for Money and Markets TV. Thanks for watching.